Being assigned. You can be assigned on the short put, buy shares at the lower strike price, exercise the long put, and sell those shares at the higher strike price. You'll receive a gross profit per share equal to the difference in the strike prices. However, because you paid a debit for the spread, your net profit will be the difference between the strikes minus the debit you originally paid. For example, with the June 50-45 put spread, you could be assigned and buy 100 shares at 45. Exercise and sell 100 shares at 50. Receive the $500 difference less the $200 debit for the maximum profit of $300. Pin risk. Pin risk is the possibility of the stock closing exactly at the short strike price at expiration. If this seems likely, you may want to consider these alternatives. Exercise the long put and risk assignment on the short. Exercise the long put and close out or buy the short put. Sell the spread. At expiration, a bear put spread may be partially in the money. That happens if the underlying stock closes between the spread strike prices so that only the higher strike put is in the money. In this case, if you're comfortable that the lower strike put will expire out of the money and not be exercised, and you're willing to assume the risk of this naked short position, you might sell the long put for its market value and expect the short put to expire with no value. However, your brokerage firm may not allow you to carry a naked short position. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.